Welcome to the Apartment Investor Show, where we help you get smart and invest smarter in multifamily real estate. I am your host, JC Castillo, founder and managing principal of the Multifamily Property Group. And joining me as always is my good buddy, my co-host, the godfather of lending, Mr. Paul Peebles, national underwriter for Old Capital Lending. Paulie, how are you feeling today?
Doing great, JC. Thanks for having us on. We appreciate that. Just getting ready for the Old Capital Conference coming on in the middle of October. Now, this is not a conference just to convince you to get into multifamily. This is kind of multifamily 101, 102, 103. It's for the next layer of education to become a better real estate investor. So go on to oldcapitalconference.com, Old Capital Conference. We would love to see you there.
Well, you know, Paulie, we are excited to bring on a guest who's been on with us multiple times, and this particular person has got a really good background on taxes, specifically related to real estate investing. And so today, what we're going to talk about is how to eliminate taxes by qualifying as a real estate professional. Now, Paulie, there is a lot of people out there that have heard of the term real estate professional. And a lot of people actually think that they know how to properly use it to take advantage of a lot of tax savings by just checking a little box on your tax return. But our guest is actually going to talk to you about why that may not always be such a fantastic idea. But more importantly, if you truly do qualify as a real estate professional, it is a very, very powerful designation that if you do qualify, that can really help you significantly too. And yes, in many cases, eliminate your taxes. So Paulie, without any further ado, and people are going to save money, so they better be listening. Let's welcome Brandon Hall of the Real Estate CPA Company. He's the CEO. Welcome to the show, Brandon, and thanks a lot for joining us.
Yeah, thanks for having me, guys. I appreciate it.
Awesome. Well, I mean, gosh, Brandon, first of all, give our listeners out there just a really quick 30-second snapshot of sort of your qualifications to speak on the subject.
Sure. So I'm a CPA. I run the Real Estate CPA, which is a CPA firm servicing real estate investors across the country. We provide tax services and accounting services. I've got a team of 17 people, and we have about 550 clients. We work only in the real estate space, and we have a lot of really small clients that have like one single family home, and we also have quite a few large clients, one of our largest being a $400 million real estate fund. So we can do it all, and anybody that comes and works with us, we can scale with them, which is a lot of fun. But real estate professional status is one of those areas that we just see mass confusion. So we finally sat down and decided that we were going to try to put something out on the internet that could hopefully be the one-stop shop. And it's definitely not as easy as checking a box on your tax return, as I'm sure we'll discuss. It took us 12,000 words to explain it. So hopefully we'll go through some of that today.
Well, one of the things that I really respect about you, Brandon, and about your company is that you guys are really, first and foremost, you're a platform of knowledge out there for real estate investors. So if anybody out there is looking for a great source of knowledge, whether you work with Brandon's company or not as a client, you can go out there and get a lot of free information. They've got a great podcast. They've got great videos. They've got an amazing website. And this particular white paper that Brandon is referring to, I've personally seen a lot of documentation out there on real estate professional status. I haven't seen anything that's been quite as well put together and extensively done, and also put into plain English so that CPAs can understand it than what Brandon has. And so really, if you're out there and you want to know all about this stuff and you like what you hear on here, but there's a lot more information to cover, go out there and download that document from his website. It is amazing. So Brandon, let's get right into it. Real estate professional status, how does it work?
So Section 469 of the tax code says that all rental activities are passive activities. And that's not that great of a designation. I mean, it can be fine as you scale your portfolio out, but especially at the beginning, or if you're running like larger properties or funds or something like that, your rentals that you're investing in are going to generate losses, and the losses are primarily coming from depreciation or from any sort of like value add rehab that you're doing, if we can mix that up a little bit, but primarily depreciation. So In the first year that I buy a property, I'm typically going to run a cost segregation study. And a cost segregation study is the practice of allocating value to components that depreciate faster. So instead of depreciating a property over 27 and a half years, which is my normal depreciation rate, it takes a long time to recover the cost of buying a property. Instead of depreciating over 27 and a half years, taking a little bit every single year, I'm going to run a cost segregation study. I'm going to front load a lot of that depreciation. I'm going to depreciate a portion of my cost over 5 years, a portion over 7, and a portion over 15 years. And with the Tax Cuts and Jobs Act, we can now 100% bonus depreciate any component with a useful life of less than 20 years. So now if I go buy $1 million apartment complex, I can probably allocate $300K of value to property with a 5, 7, and 15-year life. And now I can 100% expense that $300,000. And that's going to create a loss for tax purposes. The loss is passive. That's what Section 469 says. So full circle. The loss from rental real estate activities is passive. And there's a few ways to get around the passive loss rules. If I have a passive loss, I can offset passive income or gain on sale from another passive activity. So if I have rental A that generates 20K in loss, and then I've got rental B that generates 15K in income, they can offset each other. Then I'm left with a 5K net loss. But if I don't have any more income, any more passive income in this example, that 5K net loss gets suspended and carried forward. So I don't lose it. I just don't get to use it today. And from a time value of money perspective, I want to use my losses now. I want to get the benefit now, and I want to reinvest that benefit so that I can grow the benefit, right? But with rentals, if the losses are always or if rental real estate activities are always passive, and that means the corresponding losses are passive, and losses that exceed passive income or gain on sale from passive activity, those losses become suspended and they just carry forward year after year after year. So one of the big ways to get around the passive activity rules is to qualify as a real estate professional for tax purposes. And there's a lot of checks there. Do you want me to dive right into it?
I think let's stop right there. So if we talk about qualifying as a real estate professional, let's talk about something that you thought was really important, which I agree. And let's talk about the concept of material participation and how that relates to qualifying as a real estate professional. Because this is a very important thing for all you folks that want to go check that box on your returns and take advantage of all this depreciation.
Yeah. So to explain material participation, I'm going to have to explain real estate professional status. So let's start there. The first thing to know about real estate professional status is that it is a great marketing gimmick. It really is. I can tell people I can eliminate your income tax if you qualify as a real estate professional. So what that does is it causes everybody to want to be a real estate professional and to potentially make these elections without really understanding what they're getting into, which is also partly why we wrote the guide. But we do a lot of consulting in that area. So real estate professional, the real estate professional status. To qualify as a real estate professional, you have to spend more than half of your time and at least 750 hours of personal service hours in a real property, trade, or business in which you materially participate. So more than half your time and at least 750 hours in a real property, trade, or business in which you materially participate. The real property trades or businesses, there's 11 of them. It could be development, redevelopment, construction, reconstruction, acquisition, conversion, rental, operation, management, leasing, and brokerage. So a wide range of real property trades or businesses. The 750-hour test is relatively straightforward. Personal service time, 750 hours. The more than half your time test is what typically trips people up. So if you have a full-time job, if I'm working a 2,000-hour a year job, to meet the more than half my time test, I have to spend an additional 2,001 hours in rental real estate. So sometimes what people will do is they'll go work a part-time job instead. So they'll work a 1,200-hour a year job, then they'll spend an additional 1,201 hours in real estate. And that's still a pretty tough hurdle, I think, to not necessarily achieve. I mean, I work insane hours, and I know there's a lot of other people that work insane hours, but to convince a tax court judge that's really what you're trying to do, that's going to be difficult to do. if you're working a lot of hours in a W-2 job or in a non-real estate related business. So to qualify as a real estate professional, 750 hours and more than half your time in a real property trader business, which we just explained, the 11 real property trades or businesses, in which you materially participate. So material participation, there's 7 tests to material participation. We're not going to go through all the tests. But the main point here that I like to make is every hour that you spend as a real estate professional has to be a material participation hour. It has to be a personal service hour. So the litmus test for this is if my operations of my business, my real estate business, or if my operations of my rental would continue without me logging the hours, then my hours don't count. The hours that I'm logging don't count, right? So this immediately throws out research. I can tell the IRS I spent 100 hours on Zillow researching properties. Not going to count because the properties I have are still going to collect rent, still going to pay the bills. It also throws out education. I can educate myself all day long. Not going to count because my properties are still going to collect rents, still going to pay the bills. So when you think about this litmus test of material participation, personal service hours, I have to go down to the property. I have to swing the hammer. I have to manage the property. I have to collect the rents. I have to structure the leases. I have to really be legitimately involved in managing the property. And it's the same thing as if I were materially participating in the CPA firm that I run, right? I materially participate in my CPA firm because I literally run it.
Yeah.
This is what I do. I haven't outsourced my CEO responsibilities. So think about that. You materially participate in your W-2 job because you show up every day. You sign papers, you push things through, you work on improvement projects. That's the same sort of thing. So I can't sit back and let somebody else run the property for me and think that I am materially participating in that property, unless I have a really large portfolio, at which point I might be able to swing it, even if I have professional third-party management.
So the
this
easiest
just
way
opens up an entire slew of issues for people who have high-paying W-2 jobs, but then also want to qualify as a real estate professional and then materially participate in the rentals.
And I guess the easiest way to also say that is if I'm let's say that I'm a passive investor getting into a real estate syndication, and I'm really not doing anything other than putting the money in and letting somebody else do all the work, then if I'm trying to claim real estate professional status, I'm going to get tripped up with the material participation part.
It's going to be hard to justify. You can probably count the time that you spent in the acquisition phase, raising the capital, talking to investors. The problem is what is your role after that? And I've had people say, "Well, I'm part of the GP and I talk to the property manager and da 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 da." But that doesn't work. That doesn't work because the property manager is the one that's materially participating, not you. You're just an investor at this point. And even if you're part of the GP, you're just an investor. You are participating at the investor level, not at the material participation level. Typically in syndicates, there's a deal sponsor, like the actual one GP that is pulling significant weight in the operations. Those guys or gals are going to be the ones that materially participate. Everybody else that's been pooled together, probably not.
Gotcha. So let's talk a little bit about short-term rentals, because I think that's an area that I think is another area that where people can get tripped up, and sort of if you can tie that back into real estate professional status, give us a heads up there.
Yeah. So the passive activity rules, what we were just talking about, all rentals are by default passive. The only way to get around, or there's multiple ways to get around it, but one of the key ones is qualifying as a real estate professional, which is tough to do. You've got to really sink some hours in order to substantiate your position in front of the IRS and tax court. There's a little roundabout way to avoid being classified as a rental activity under the passive activity rules. And that's to buy a short-term rental, commonly known as like an Airbnb or VRBO type of a rental, and have the rental period per tenant be an average of 7 days or less. So if I have 10 tenants, I need to be renting it for 70 days in the aggregate or less. Bam, I meet that rule. If I have a short-term rental where my average rental period is 7 days or less per tenant, then I am excluded from the definition of a rental activity under Section 469 of the code. And what that means is I don't have to qualify as a real estate professional to overcome the presumption that my rentals are passive. I just have to materially participate in the activity. So much lower hurdle. There's 7 tests to material participation. One of the tests is that you complete substantially all of the activity. People have, in tax court, people have successfully demonstrated that they've materially participated by only logging about 60 hours for the entire year. That's all you have to do with a short-term rental.
Wow.
Now, if you complete substantially all the activity, that also means you can't have a property manager, right? Because then they're the ones that complete substantially all the activity. So now you're going up the chain of the tests that you have to meet, and the hours just get higher and higher and higher with those 7 tests. But it's a really great strategy, especially if you're a high income earner, you don't have access to the real estate professional status, or you might think that you do, but then you come talk to us and you realize you don't. This is something that we'll also throw out there by saying, well, do you want to buy a vacation home? Do you want to rent it out on Airbnb? Buy it in September or October, self-manage it through the end of the year. It's a calendar year look, right? So for 2020 or 2021 or whenever you listen to this podcast, for that year, I had a short-term rental, 7 days or less, and I completed substantially all the activity. Bam. That's a non-passive activity at that point that we can claim against all of our W-2 income. You can cost segregate it, accelerate the depreciation, and get a nice tax refund.
So Brandon, let's talk a little bit about we can change gears a little bit. So maybe people out there listening are thinking, well, I thought it was easy enough to check the box, but now I'm sort of second guessing myself. And maybe they're a high income W-2 earner, but maybe they've got a stay-at-home spouse that is willing to actually do the work to qualify and manage the real estate portfolio. Can you talk a little bit about how that actually might be advantageous?
Yeah. So if I'm married and my spouse qualifies as a real estate professional, then in the aggregate between my spouse and myself, we have non-passive rental losses that we can claim against my income, my breadwinning income. So totally doable. The issue is that what we have found most of the time, the breadwinner is also the one that hates paying taxes and wants to shelter their income from taxes. The spouse doesn't really care in most cases. And so the issue that you run into is the breadwinner is the one that's actually pulling all the strings, and maybe they go set up a joint email account and they're signing under their spouse's name and doing some shady things to try to say, oh yeah, my spouse hit the 750 hour and more than half her time test. The problem is that when you get into tax court, it's all about credibility. You are trying to prove that you are credible. The IRS is trying to prove that you are not credible. And the tax court judge has to decide who's more credible. That's essentially how these things work. So if your spouse takes the stand and has no idea what's actually going on in the day-to-day operations, they've logged thousands of hours, but when they're testifying, they can't recall any details, you're not going to look credible. You'll be toast. So if you're going to do this strategy, it's a great strategy. We love it. But if you're going to do it, the spouse has to legitimately take a role. Otherwise, it can come back to bite you.
Yeah, if I could walk into a grocery store and steal a bunch of merchandise and run out, and I never get caught, I like that. But tell us a little bit about what your experience has been for people that actually marked it down that they were a professional. The tax court brought them in, and what are some of the fines? What's my punitive damages?
That's a great question.
I can
Paul.
find.
Yeah. So it depends. You could pay penalties. So first you have to pay the tax that you should have otherwise paid. Then you have to pay interest on the tax. And then you could pay penalties anywhere between 20 to 75%, depending on how bad it is, how bad the understatement is. So it can get very expensive. And you've racked up legal fees, CPA fees to defend you all that way and help you out.
Have you seen very many of your clients that have actually been challenged by the U.S. Treasury and IRS, so to speak, that they brought them in?
Yes. And the way that it has worked is, yes, the way that it's worked in our experience is we had a slew of clients and new clients come to us all from one tax preparer who was checking the box for all of his clients. And that tells me that the way that these audits work is that the IRS is trying to get in and out as efficiently as possible. So I have a preparer identification number. If they audit one of my clients and my client loses because they're counting education and research hours or because they're not actually qualified because they don't meet the tests, then they're going to go cool. Let's also look at 3 additional clients that Brandon has, and with similar facts and circumstances. Let's pull them and just see what we get. Same facts and circumstances, they all lose too. Everybody gets pulled. So in my experience, granted, short relative to other folks that are in this space, but my experience has been that they will just pull everybody in a client base. So you have to be careful who you work with, and that's a big part of what I like to tell prospects on the phone, like people that are looking at potentially working with us, because I'll tell them, hey, your education and research hours don't count, and they get all mad. I'm like, look, they'll say, oh, well, this other CPA says that they do. I'm like, listen, I get it. They don't understand what they're doing. And here's how the audits work. You have to be careful because they're telling everybody that that's how it works, right?
Yeah,
they're telling all their other clients. All it takes is one of them to get pulled for an audit and everybody else is toast.
So we're recording this prior to November the 3rd. So what happens after November 3rd and there's a trifecta that goes on in through the elections? Are all bets off? We've talked a little bit about bonus depreciation. We know that that's kind of grinding itself and sunsetting at some period of time. But we haven't really talked about maybe 1031 exchanges, higher ordinary income. I mean, what's as a prognosticator? What's your 2 cents about what's going to happen? I guess nobody knows until November 3rd or 4th. But what's your 2 cents?
Yeah, that's the crystal ball that if I knew, it would make us a lot, right? I don't know. I mean, I think that in my experience looking at politicians and what they promise, it's a lot of marketing gimmicks. It's let's figure out what pieces of the code we want to either change, enhance, or eliminate to communicate to my base of voters. And connect with them better so that they actually vote and come out and vote for me. I mean, 1031 exchanges have been challenged for years, and the challenges all fall flat because if you eliminate a 1031 exchange, it's been shown that the economic repercussions of that are going to be huge. So I don't know. I don't know what's going to happen. I don't think that real estate professional status is going to be is at risk. One of the reasons is you take all the losses today by qualifying as a real estate professional, but at some later point, you've got to recapture those losses because they're all coming from depreciation. So I think that it's just a timing difference. I don't think that it's going to be on the chopping block. I'm not really sure about the 2017 Tax Cuts and Jobs Act provisions, like 100% bonus depreciation. What exactly is going to happen there?
Yeah. One thing that I can definitely plug for you, Brandon, is that if anybody out there listening wants to get subscribed to their newsletter, Brandon's newsletter from his company, very recently he put out a couple of different blasts that talked about Joe Biden's proposal for tax changes, and also they weren't exactly clear, but where the Trump election campaign stands in terms of the tax changes, or actually maybe the lack of tax changes. So actually that was a really helpful write-up that Brandon, that you sent out. And I think it gives a clear snapshot of what are some of the potential, gotchas if Biden were to get all of his, proposed changes. But as you say, and as I always say, is that what they get elected on and what they actually pass are usually a little bit more of 2 different things. One is a little bit more watered down.
Yeah, exactly. Yeah. And there's always pushback too, and things get modified. But yeah, the newsletter, it's a relatively new newsletter that I've launched. But it's funny, those 2, I got hate mail on both of them. Just people just saying, you're a CPA, you shouldn't be commenting on politics. I'm like, all I'm doing is summarizing what the tax plan is. I have not said if it's good or bad. I haven't said who to vote for. I'm like, dude, what do you want from me? Oh, it's crazy.
A little, you know what? A little bit of ruffling feathers is always good. I myself didn't see any sort of politically motivated intentions. I just saw it as factual information. So for me, it was amazingly great.
I appreciate that.
The tax status, being a professional real estate investor, is really a kind of a federal federal piece. How many guys that are in state income havens like JC? Does the state of California recognize JC in his real estate professional designation?
Great question, Paul. So California is the one state that does not conform to real estate professional status. There
Of
are
course
several
it is.
states that don't conform to bonus depreciation, but yeah, California's the one.
So what does it mean for a guy like me in California, Brandon?
So what that means is if you qualify as a real estate professional and you take all the losses as non-passive, you can do that on your federal returns. But for California state purposes, you'll have to prepare a return that basically says, I did not qualify as a real estate professional and all my losses are passive. So you basically don't get any of the state level benefits. It'll be, your state might say you've got 300K of income, whereas your federal might say you've got 50.
Yep, that makes a lot of sense. Well, you know what? We pay.
When are you moving to Texas?
We pay for the
JC?
sunshine out here in California. I tell you, it's
That's a big tech to enter the show.
It is. It is. We'll have to see. I definitely invest in Texas. I've so far have stayed here and paid my sunshine tax.
Yeah, California is a great state. I got caught one time saying, somebody asked me on a webinar, I was like, how do I avoid taxes? I was like, gotta move. And then I was like, that was not I probably shouldn't say stuff like that. California's a nice, it's a great looking state. Just kind of tough with taxes. So.
That's exactly, you couldn't have said it better, Brandon.
So any other words of wisdom right now, Brandon, that we should be knowing? I mean, our taxes are really not coming due anytime soon, but any preparation that folks should be looking at right now?
Yeah, well, I mean, once you understand real estate professional status and that short-term rental piece, it's really just an acquisition strategy and the timing of your acquisitions. So if you are a real estate professional and you do materially participate in your rentals or your grouped rentals, then you start acquiring property. And if you pick up a property and it's in service by December 31st, you cost seg it, you front load a lot of the depreciation. But I just want to throw the warning out there that this is a piece of the code that's not as gray as people think. A lot of people are like, well, my tax advisor told me it was gray, or they'll say, well, there's a lot of different interpretations. There's really not. There's a lot of tax court cases that provide really clear guidance in terms of how this stuff works. And you just want to make sure that you're working with somebody that's going to tell you what you need to hear to win audits, not what you want to hear. A lot of people want to hear that my non-working spouse who's not interested in real estate is going to be a real estate professional. They want to hear that my education, my 400 hours of education and 200 hours of research are going to count, or even my 50 hours of education and research are going to count. They want to hear that because those are the easy things, but that's going to set you up to fail. And we take a very hard line approach to this where we tell people what they need to hear to win IRS audits.
I mean, we absolutely love it, Brandon. And that's why we always say that we love to get our information straight from the experts and not from talking heads. And certainly you would qualify as an expert here.
Appreciate it.
So we appreciate the time, Brandon. Some great information. Again, if somebody wanted to get a hold of you and kind of get onto your website and engage you, what's the best way for them to get a hold of you?
Yeah, just www.therealestatecpa.com. We've got a big orange Become a Client button at the top of the webpage. So you just click that, fill out the form, and be good to go.
That sounds great. JC, tell us a little bit about what you guys do.
Well, what we do, Paulie, we've got a real estate syndication company. We are a private equity company that raises capital for large-scale multifamily properties, and we've been doing it for 14 years. So we have gone through the ups and downs of a complete market cycle. The biggest thing that we do out here is we help investors sort through all the noise, and we help them get educated and make smart investment decisions when it comes to multifamily. I mean, if you want to talk to us about the stock market, we're not going to be able to help you out. You want to talk to us about buying gold, we're not going to be able to help you out. If you want to talk to us about investing in multifamily, you want to diversify into multifamily real estate, that's something that we can absolutely give you great advice for, and we can help a lot of people with that. So if you feel like getting introduced to myself and our company, go to our website, multifamilypropertygroup.com. Again, multifamilypropertygroup.com, and you can just literally click on the homepage, schedule a consultation, and you will be able to get a 15-minute consultation with myself. And we would love to see how we can help you out. That's what we got, Paulie. That's what we do.
Yeah, and I don't want to make this break California's chops, but I think I'm going to. California investors have enjoyed huge amounts of appreciation on their properties, and we're starting to see a little bit of a backslide in California. People in the Silicon Valley have made decisions because of pandemics that you can kind of work or play in other areas, and we've started to see a huge drop in rents. And so maybe some people that have owned real estate in California that probably want to take their chips off the table and possibly sell and come to a friendly state like Texas. And I'm going to say Texas, but maybe Utah or Phoenix. But maybe they don't know how to do it because they've only owned maybe an 8-plex or a 24-unit building in California, but they don't want one of the research. JC, can you help them out, JC, and kind of guide them and maybe partner up with them? Does that sound reasonable?
Yeah, it's such a great point, Paulie. I mean, look, we've got a lot of high net worth clients, and it's actually been picking up quite a bit, but the trend was already there before the pandemic. A lot of high net worth clients that have very high value, high dollar real estate investments in California who are starting to liquidate those assets, and coming out of 1031 exchanges, they're looking to get into more business and landlord friendly states like Texas. And so we have an amazing advisory services business where we can actually help these high net worth clients and help them get into a market like Dallas-Fort Worth, where we have been operating for 14 years and find an absolutely amazing upleg on the 1031. And we also work very well in terms of understanding all of the tax implications in terms of how you structure these deals to make sure that their 1031 exchange is maintained. And the benefit is that they get into a great state and they become a little bit more hands-off because we can help them with a lot of the heavy lifting in terms of the the servicing of that particular investment. So if you're out there and also you've got you want to get out of California or some of these coastal markets that have some really a lot more stringent rent regulations that are happening now, definitely reach out to us. We definitely can help you get your money to work for you in a much better location from that perspective. So, Paulie, thank you for pointing that out.
Yeah, no problem. Brandon, thanks for hanging out with us. We certainly do appreciate you spending some quality time of kind of going through this. This could be a complicated subject because the people that we're talking to are usually typically high net worth people, and they're trying to legally reduce their income as much as possible. And there's huge amounts of incentives to get it done. And talking with you, making sure that it gets done correctly. So we'll stop our conversation today. But I know that I'll want to talk with you before the end of the year when we get some clarity of what the Congress and the Senate and the executive branch are thinking at that period of time, and then we can kind of maybe do some figuring out and strategizing going into 2021. So Brandon, thanks for your time. Again, we appreciate that. JC Castillo, thanks for spending some time. I'm Paul Peebles. Have a great day.